Ever wonder how people actually make money from the stock market? Or lose it? Let's break it down simply. No jargon, no hype, just the real story of how the stock market works. What is the stock market? The stock market is like a big marketplace, but instead of buying clothes or food, people buy tiny pieces of companies. Each piece is called a share or stock. When you buy one, you're literally becoming a small owner of that business. There isn't just one single stock market. There are many exchanges where this buying and selling happens. The two biggest in the US are the New York Stock Exchange, or NYSE, and the NASDAQ. Think of them as giant digital meeting places where millions of investors trade stocks every second. Prices move up and down constantly, based on what investors believe a company is worth, and those beliefs can change fast. Why companies go public? So why would a company want to sell pieces of itself to the public? It's all about raising money. When a company wants to grow, maybe to build a new factory, hire more people, or expand internationally, it can either borrow money or sell ownership. Going public through an IPO or initial public offering lets the company sell shares to investors for cash. In return, the company gets money to expand, and investors get a chance to profit if the business succeeds. How investors earn money. Okay, so how do investors actually make money? There are two main ways. First, dividends. Some companies share part of their profits with shareholders. That's called a dividend. It's like a thank you check for owning their stock. Second, if you buy a stock for $100 and later it's worth $150, that's a $50 gain if you sell. Of course, prices can also drop, meaning you can lose money too. Stock prices are influenced by tons of factors: company performance, interest rates, the economy, even investor emotions. That's why investing isn't gambling, but it's not guaranteed either. The key is time. Over long periods, the stock market has generally gone up, rewarding patient investors. A short history. The idea of trading ownership isn't new. The first modern stock exchange began in Amsterdam in the 1600s when the Dutch East India Company sold shares to fund voyages around the world. Fast forward to 1792 when 24 stockbrokers signed the Buttonwood Agreement on Wall Street, creating the foundation of the New York Stock Exchange. Then came the NASDAQ in 1971, the first electronic exchange, paving the way for the tech stocks we know today. Since then, markets have grown from a few dozen traders shouting on a floor to powerful global networks that process billions of dollars a minute. Real-world examples. Let's look at two famous examples, Apple and Amazon. If you bought Apple stock in 2001, when the iPod launched, you'd have paid around 30 cents per share, adjusted for splits. Today, that same share is worth well over $150. That's thousands of percent in growth just by owning part of a great company long term. Amazon tells a similar story. Back in 1997, its stock debuted at just $18 per share. Despite ups and downs, it's grown massively as the company revolutionized online shopping and cloud computing. Of course, not every company succeeds like that, which is why diversification or owning multiple stocks helps reduce risk. Why it matters. The stock market isn't just for millionaires or day traders. It's where pensions, retirement accounts, and everyday savings grow. When the market rises, it often signals confidence in the economy. When it falls, it can reflect uncertainty or fear. In a way, the stock market is a living, breathing snapshot of global optimism and sometimes panic. So now you know what the stock market really is: ownership, opportunity, and risk all in one place. If you found this helpful, hit subscribe. And in the next video, I'll show you how to buy your first stock, step by step.